The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, he's back from a break and still more popular than FIFA's Gianni Infantino. It's my Chanticleer colleague, Anthony Macdonald. How are you, Anthony?
Still waiting on my call for President Trump, mate.
Keep waiting. Today we explain what job cuts and Jetstar's cabin baggage fees tells us about the Great Australian Squeeze. We look at how the ASX hit a record high and ask why no one seems to be celebrating. And we unpick America's strange mission to save the land of the rising sun. But first, Anthony, we learnt this week we're going to get a big new miner on the ASX very soon, with the Swiss-based giant Glencore planning a listing down under now. Glencore's many things. It's a big commodity trader, it's a big copper miner, but it also mines a heck of a lot of coal. Anthony, I thought the days of a new coal miner listing on the ASX were long gone, but what's happening here?
Coal's back, baby. Or at least Glencore reckons it is. I mean, it reckons that sort of anti-coal push has been drowned out, or drowned out enough at least, to get a secondary listing here on the ASX, which means Glencore shares will trade here under the ticker GLC from October.
Yep.
I mean, the goal is to have it qualify for the ASX 200 within 12 months. And to do that, it reckons it needs about $1.5 billion worth of stock to come to Australia. So, I mean, shareholders in Glencore, they're the ones that are going to have to transfer that stock here. But ultimately, it's up to them. I mean, that should be achievable, $1.5 billion. I mean, we're talking about, 1% or so of the company's shares on issue. There's quite a few Australian shareholders already. I mean, they would like to hold some shares in Australian dollars. So you think they'll be the ones that will be leading this push. But from Glencore itself, it's a noticeable shift. Like, I remember asking them a few years ago about this, and it was like, absolutely not. I mean, you Aussies, you think you're a mining-friendly country, but you're probably the toughest in terms of ESG expectations. I mean, they weren't having a bar of it back then, but now, they think that things are okay. And the Glencore CFO, Steve Kalman, who's an Aussie, he's probably better than your average CFO. I'd say, like, he literally said on the investor call this week that if you compare Australia's market to a few years ago, if you look at who owns the coal miners here, Whitehaven Coal, New Hope, etc., he said their share registers had matured, was his word, and investor appetite for both coal or coal as part of a bigger diversified portfolio had improved or increased over the years. So they basically think it's a bit more friendly than it was. I mean, that's led by the big super funds. I mean, the super funds have probably become the ESG stewards in the Australian market.
Totally.
And a couple of them are quite outspoken, particularly around things like coal. I mean, Australian Retirement Trust, Hester, for example, don't want a bar of it. But Australian Super, which is the biggest of the funds and the biggest Australian equities owner, I mean, it's been asking Glencore to come here. So I think that really helped the push. But anyway, I mean, it's good they're coming. It's good for the ASX. It's good for public capital markets. Glencore's got 17,000 employees in Australia. Mine's coal, copper, zinc, nickel here. It should have always been listed here, really. I mean, we have BHP and Rio. We have all the mining sector infrastructure set up around it. There are some hairs on it though, James, and I mean, it's going to have to do some serious work, I'd say, educating the Australian mining public to make this thing work. I mean, are you excited about this one?
Well, I guess I've got a question. I think Glencore's right. The mood in Australia around ESG, that's environmental, social and governance matters, it has changed remarkably. But do we go all President Trump here, Anthony, and say, woke capitalism is dead and that shift is what's allowing Glencore to return? Or, does it reflect the fact that energy security and reliability is now as important as those ESG matters? Is that reading too much into all of it?
Well, I think Steve Kalman's word matured wasn't the worst word to use. I mean, these sorts of things do come and go in terms of the urgency of them, and it depends what else is going on in the world at the time as to things like coal. I mean, if you think about the energy transition, the way we talk about the transition in Australia, James, I mean, by now we're supposed to have shut off a few of these big coal-fired powered plants, and some of them have, but I mean, we've got like Aurora here in New South Wales. That was supposed to be shut off a few years ago. Still not shut off, and it's going to be open for the foreseeable future. What feeds it? Coal.
Yep.
I think we have changed our thinking a bit. The reality of transferring to the renewable sources has really hit home.
Anthony, one thing I'm excited about is that Glencore is definitely not boring. Rio and BHP, they used to do wild and crazy deals and make big mistakes, but they've got a bit sort of boring in the last few years, very well disciplined, don't do too much out of the ordinary, but there's always a bit of drama around Glencore. They've had sort of plenty of brushes with the law over bribery issues in the past. Their safety record has been a bit patchy for a long time. So there's always going to be, a lot of movement and colour around Glencore. There's always a story, which is great for journalists.
Yeah, mining sector hardheads, aren't they? Okay, James, anyone who's been to Japan knows, and you, Japanese James Thomson, know best of all, you seem to be going there every 5 minutes.
Yeah.
The yen has been very weak against the Australian dollar and the US dollar for a long time, making it very cheap to travel to Japan. But this week, the financial world has been abuzz with the story of America and Japan joining forces to help prop up the value of the yen. What's this all about, and will it make it more expensive for Aussies to travel to Japan?
I don't think this intervention in the yen is going to have too much of a long-lasting impact. Don't worry, your trip's still going to be good value for money if you're heading off to Tokyo or the Japanese ski fields in the coming months.
That's your trip, James, not my trip.
This is a really interesting story. I mean, the yen is weak for a number of reasons. Japan's got a massive government debt that worries some investors. Japan's a big importer of energy.
Yep.
They don't really generate any energy. They have to import everything. And so the increase in the oil price out of the Iran conflict has basically weakened the yen because Japan has to sell more yen to buy more dollars to buy more oil. So there's that. And then there's this sort of longer term story of Japanese interest rates are very low compared to interest rates in other places, particularly in America. So what that means is you can borrow cheaply in yen, take that money and then invest it in American assets and you get a much better return. It's called the carry trade. But the weak Japanese yen has some consequences. One of those consequences is it gives Japan, in the eyes of Donald Trump at least, an unfair advantage in trade. So Trump doesn't like it for that perspective. And the other thing is it creates volatility in currency markets and in bond markets particularly, which can, lead to some instability. So from time to time, the Bank of Japan intervenes in currency markets and tries to push the value of the yen up. Now, moving currency markets around, you can do it for a little while, a week, couple of weeks maybe, but it's hard to do long term. But what we've seen in last weekend basically was Japan and the US join forces to wade into currency markets and try and push the value of the yen up against the US dollar. The way the US did this was selling some of their reserves of euros, taking that money and buying yen. They expanded the Federal Reserve, the central bank in America. They expanded the Fed's balance sheet, used some of that cash to prop up the yen too. Why would America go and help Japan?
Yeah.
Well, it all gets back to the cost of borrowing in America. If a weak yen forces Japanese bond yields to rise, what might happen is that Japanese investors who've invested a lot of money with that yen carry trade in America, they might start bringing that money home. They'll sell US government bonds and the yield on those bonds will rise because bond prices and bond yields move in opposite directions. When bond yields rise in America, that means borrowing costs rise too. Just this week, we've seen the US mortgage rate hit its highest point in a year. So basically, America wasn't doing this selflessly. They weren't doing this to save Japan. They were doing this to try and help keep borrowing costs in America down and try and keep Americans worrying about cost of living less grumpy with Donald Trump heading into the midterm elections in November. What's interesting, though, is this a sort of coordinated intervention by Japan and America hasn't happened in 28 years.
Wow.
And it really shows that the big hand of government is intervening in markets all over the place. And I think that's something investors are going to have to live with. Government intervention is a fact of life. It generally pushes up the cost of capital and it will eventually come through and hit your portfolio as it results in higher borrowing costs. So, yeah, it's a bit of a moment for markets and a big talking point.
Got it. So you're saying Japan's a huge holder of US treasuries, their bonds, the biggest in the world. US doesn't really want Japan selling those bonds to have to buy its currency alone. That would send the bond prices down, the yields up. So it's in the US's interest to act here as well. So is it confirmed that these two countries are sort of acting together on this, or are the buying just happening at the same time?
No, this is definitely a joint effort. Both the Americans and the Japanese have confirmed that they work together and are willing to continue to work together to prop up the yen. Now, The yen strengthened for a couple of days. It's already starting to weaken again because Japanese interest rates, whatever happens, Japan's debt isn't shrinking and Japanese interest rates aren't moving up to anywhere near American interest rates. So that sort of fundamental issue remains. So whether we see the Japanese and US authorities trying to do this again, I'm not sure. The problem is these interventions in currency markets, they don't work long term and they cost a lot of money. So let's see what they do next time.
Okay.
All right, Anthony, let's move to our first topic, which I'm calling the Great Australian Squeeze. This week, we got a perfect example of what I'm talking about from a single company, our dear old friends at Qantas. First, two of the AFR's crack reporters, Aisha de Kretser and Ed Tadros, broke the news that Qantas is considering outsourcing 1,000 jobs to India with a big consulting firm called Accenture. And then the next day came the news that Jetstar will start charging people more than $50 to whack a cabin bag in the overhead locker on Jetstar flights. Anthony, my theory is this is all part of the big squeeze. For the past 5 years, costs in corporate Australia have been growing much faster than sales. Costs are up about 10%, sales are only up about 7%. And as the economy starts to slow amid higher inflation, we're going to see a wave of cost cutting as companies squeeze their workers and squeeze their customers to try and grow profits. Anthony, I reckon this is going to happen everywhere, and I don't mean to pick on Qantas. I think we heard news this week of Coles doing a similar outsourcing deal with Accenture to India. But what do you think of my great squeeze theory?
Well, it's got two parts, doesn't it? I mean, the sales side, the revenue growth side, outlook there is pretty weak. You know, GDP growth was supposed to be 1.3% this calendar year, 1.3% for the coming 12 months, according to the RBA. That doesn't scream strong sales environment, does it? I mean, that's half what the GDP growth was last calendar year.
Yeah.
So I agree with you. Revenue growth is going to be really hard to achieve. And then on the other side, the costs, yes, inflation. It's supposed to be running at 4% this year. We're bloated on the cost side already. I mean, I straight away think of the banks. We went through result after result after result for a few years there of cost growth above revenue growth. A couple of the banks have started turning that around, but it's going to be hard to do that in this low GDP growth environment. So yeah, I mean, we've got this AI thing ticking away in the background. I think 6 to 12 months ago, we were hopeful that was the answer to the cost pressure.
Yeah.
For now, though, I mean, it's just adding more cost pressure. Companies are paying for it, but not really getting the efficiencies yet. Maybe it comes good, but companies going to have to do more. And we saw those Qantas stories this week, James. I mean, considering outsourcing and charging for Jetstar's overhead baggage.
Yes.
I understand, like, big company under pressure to cut costs and, you know, and shareholders will like that story. But I'm scratching my head a bit, to be honest, James. I mean, we've just come through this really tough period for Qantas. You know, they did lots of apologising. We've heard them at our summits talk about how this business is the staff and staff morale took such a hit post-COVID. I mean, we've heard about how customer satisfaction took a massive hit as well in that sort of COVID era too. Their reaction now is they're talking about outsourcing, which is incongruous with the whole staff comment, and then things like charging for overhead baggage, which surely just pisses off customers. So, yeah, I mean, I kind of wonder how it fits into the bigger picture for Qantas and the whole "we're sorry" story that they've been telling for the past few years. But, you know, I get it. They're a big company. They've got to do something. But, James, like I said, this squeeze is happening as AI starts to be deployed across the economy. Do you think this squeeze might speed up the adoption of AI?
I think history would agree with that, Anthony. You know, when we have moments of economic weakness, it does tend to force people to adopt new technologies faster. Now, what's happening with the adoption of AI, it's such a murky picture. I think we've seen sort of 3 separate surveys this week that says the adoption is happening, albeit pretty slowly. We've seen a separate survey saying, don't worry, more jobs will be created than are lost through AI. We've seen another survey saying AI costs are starting to become a meaningful part of businesses' total expenses. So I'm with you. I think we're seeing adoption of AI is helping to boost individual productivity. So, you know, a manager or a worker might be feeling more productive or managing to generate more work, but it's not really showing up at a company-wide level and certainly not an economy-wide level. This sort of big squeeze, the pressure to cut costs, that could be the sign for companies to invest not just the money, but the time and the resources to make this work. The big challenge here is that it's not just a thing where you're like, go to Microsoft or go to Google or go to whoever and say, can you AI me?
Totally.
It doesn't work like that. You've got to change lots of different things about the way you work, the way your organisation is structured, the way your people approach the individual tasks that make up their job. That's the hard bit. That's the bit that companies are struggling with, I reckon. How companies are going with AI is going to be a big part of reporting season, which is getting underway at the moment. Analysts and investors are looking for answers on how AI is being deployed, what are the actual benefits. But we're also getting already some signals that there's going to be a lot of attention on costs. Is this cost question going to be a defining feature of the corporate sector, well, over reporting season, but more broadly over the next 12 months?
I think it's going to have to be if companies are to grow earnings, James. I mean, consensus across the ASX 200 is for about 5% earnings per share growth in FY27. You know, like I said, not lots of top-line growth there, so it's going to have to be cost.
Yeah.
Management's always good at talking about cost cuts, though. You know, analysts are great at putting them into the spreadsheets, but they are hard to pull off. They're hard to pull off well. It's just human nature. You know, management's much better at spending money than saving. So I think we should hold judgment on saying cost cuts will be a defining feature of reporting season. Yes, there'll be a lot of attention on costs, as there should be. I haven't seen a lot of their costs stuff yet, James, to be honest. I mean, I looked at AMP yesterday. It wasn't really a cost story there. Was there much in REA when you looked at it?
There was a bit, but what's interesting here is you got to do a lot of work just to stand still.
Yeah.
I mean, good cost control at REA was, you know, keeping costs growth to sort of 6 or 7%. The minimum wage is going up by around 5%. Just standing still and holding costs to inflation, even doing that is the challenge at the moment.
Yeah, what do you think this big squeeze means for consumers? I mean, the Qantas example would seem to suggest pressure on employment at one end and pressure on prices at the other. That's not good for the RBA, surely.
Feels a bit stagflationary, doesn't it? You've got a slowing economy at one side and then companies that have pricing power, and clearly Qantas is one of those, they're using it. So, no, it's not good for the RBA. This is the sort of worst of both worlds that they don't want to see. They want to see unemployment ticking up a little bit. Now, they're not hoping that people lose their job, but they want to see the economy soften and a bit more capacity in the labour market, and they want to see prices start to come down. This is the difficult sort of equation for the RBA. Companies with pricing power that have strong market positions, they're going to be pushing through higher costs onto consumers, and then they're going to be trying to cut costs at the same time. So that's why I think we get this squeezy sort of environment for the next 12 months, perhaps even a bit longer. This is the price you pay for crappy productivity growth and high inflation. I don't know, is there an easier way out of it? I can't see one.
Yeah, I mean, I'd added screwing down regulation onto your list. Business has got harder. That catches up to us, right? And I think that's what's happened at the moment. Like I said, that 1.3% GDP growth forecast for the next 12 months, that's a shocker for Australia.
Yeah.
I mean, like, that's just not us. You know, that's like Europe stuff. we really need to be aspiring to do more. And unfortunately, I think we're paying for sort of 10, 15 years of going backwards on a few measures.
Yeah, that's a good segue to our next topic too, Anthony.
Okay, James, let's hear it for the little Aussie battler. The ASX 200 grinded its way to a new all-time high this week and suddenly is up a pretty respectable 6% for the year to date. Now, there's a distinct lack of dancing in the streets at this news, but it's a pretty impressive little run the local market's been on. What are the drivers of this rally?
I think there's two major drivers, Anthony, or maybe three. Yep. Over the last month or so, it's been a good time not to have a whole lot of AI exposure in your local market. Australia doesn't have that. There's no Microsoft or SpaceX or Amazon or Alphabet here. We're dominated by banks and miners. And so as the AI trades had a little bit of a wobble in the last 6 weeks or so, that's benefited Australia. We've seen some, particularly Asian investors, move back into this market and use our banks and some of our retailers as I guess, safe havens. So that's benefited us a little bit. But I think the two big ones, there is a sense out there amongst Australian investors that the RBA is done raising rates.
Yep.
I don't necessarily agree with that, I've got to say, but there is a sense from many investors that the RBA's turned dovish, that Michelle Bullock doesn't want to continue to hike. She's happy to hold for a long period. And so we're at the top of that rate cycle, and that allows investors to feel reassured that they're not going to see more pressure on borrowing costs. And the other factor is the war in the Middle East. Now, I must admit I'm struggling to keep up. We seem to veer from peace to threats of war, from peace to threats of war to something in between every second day. But what Australian investors have decided is that the direction of travel is positive. That is, America wants to get a deal done. It's going to take a little bit of time. It's a bit messy, but eventually a deal is going to be done. The energy sector has held up pretty well, but, we should be able to get a deal before the end of the year. Again, there's no guarantees on that, but that has certainly, I think, helped lift the spirits of local investors. Am I missing anything, Anthony, from that list?
I think you're right with your list. I mean, it's been a funny rally. I was just looking at this yesterday and trying to see what had been going up, what had been going down on a sector by sector basis, and it's kind of been a lot of a rebound sort of rally. Like a lot of the software stocks and that have been sold off, they're the ones that have really sprung back hard in the past week or 10 days. I mean, the banks have been going okay. The miners struggling a little bit, but I don't know. To me, it just feels like a bit of a sentiment thing. And I know you and James Chessel talked about de-dollarization a little bit last week, but whole, investors in the region looking to shift money perhaps out of the US into places like Australia again, that sort of Australia safe haven-y sort of story.
Yeah.
I mean, that feels like that might be playing out. But it's sort of chopped and changed as well every day. Like, I mean, on Thursday, it was all the gold miners were up. I looked at one stage on Thursday morning and the top 14 stocks in the ASX 200 were all gold miners on the back of the gold price. It was all the risky stuff that had been sold off, yet the market as a total was still going up. So it's a bit all over the shop.
I agree. Anthony, you wrote a cracking column this week talking about how the ASX is hitting this all-time high and pointing out that companies are in the middle of a wave of share buybacks. Now, for those who don't know, this is a way for companies to return money to shareholders by going into the market and buying back their stock and then cancelling that stock. So the earnings per share or the share price does drift higher. But Anthony, as you pointed out, if companies are using money to buy back stock, they're not using it to invest and become more productive, which is sort of what we need them to do, right?
That's correct, James. And the problem is buying back shares is often a good strategy for investors. Like you said, it's normally earnings accretive, normally helps the share price over the long term. It's good for management, often helps with their bonuses because they'll be tied to sort of earnings per share metrics. So when you're reducing the number of shares on issue by buying them back and your profit stays the same, your earnings per share goes up. So, I mean, generally it's a good strategy. Problem is though, you're buying at the moment when markets are at an all-time high. A lot of share prices are at highs as well. I mean, there's about a dozen stocks whose shares have hit 1 year highs in the past 10 days, James, like Computershare, Macquarie, AMP, are just a few of them. So it does pose a bit of a problem for companies. Like, how much do you keep buying shares when share prices are elevated? Is that really the best use of capital for shareholders?
Yeah.
Now, just generally, investors, like I said, they like buybacks, but hopefully this reporting season, they start pushing management and just say, look, valuations are pretty strong. The market's at an all-time high. You've got this excess capital here. Have you thought about investing it? Right?
Yes.
Have you thought about trying to do something else? Have you got another business case? Can you just work a little bit harder to try to make your business a little bit better in a way that isn't just financial engineering and buying back some stock? It's a first-class problem to have that buybacks are a little bit unattractive because share prices are high. But I think we should be encouraging boards to be pushing management teams to come up with some alternative uses for that excess capital at the moment. I mean, I'm trying personally to be a bit more positive about reinvesting capital this year. We're stuck in this low productivity environment. Business capex is a big problem. It's hard to have conviction to reinvest. I know when GDP growth is only supposed to be 1.3%, you're basically saying you're to invest money into a low growth environment. That's not ideal, but I think we're kind of at the stage now where we need boards to have a crack. We need management teams to have a crack. Ultimately, it doesn't matter what I say, it's what investors think. Yeah. But I think there is this sort of growing groundswell out there in the Australian active equities community that this productivity problem, it's not going to resolve itself. We can't just all sit back and look at the government and ask the government to fix it for us. Business does have to step up. Investors do need to give the business the ability to step up and a little bit of leeway. So I'm going to be watching this reporting season, James, just to see if there's a bit more sign of CapEx programs, of good ideas that companies can get behind. But also, for investors to sort of give their companies a bit of rope, particularly those ones whose shares are trading so strongly. Yeah. And where you can sort of question whether buying stock at today's prices is a good use of money.
Is this a bit of a symptom, though, of the government's tax changes particularly around capital gains tax? Like, it doesn't send a signal that we want you to grow. It sends a signal that you're better to return capital, doesn't it?
Yeah, unfortunately, capital gains tax changes trap capital in low growth, stable sort of businesses. And I mean, it's contrary to what the country needs in terms of investment in growth, unfortunately. So yeah, I agree. The tax changes definitely aren't helping. James, so you said, I mean, local investors, they're comfortable that the RBA's stopped hiking. They're comfortable that the situation in Iran is sorted out. What is there to still worry about?
House prices, Anthony.
Oh, yeah.
House prices are still the thing. One of the big question marks is, does the weakness in house prices lead to a sort of negative wealth effect where people stop spending? And how does that ripple through sectors like retail, consumer discretionary, think JB Hi-Fi and Nick Scali and companies like that? How does it even go through to, financial services companies, wealth managers, all that sort of thing? Banks, what does it mean for credit growth for the banks, which have had a nice little run in the last 6 weeks or so? So I think house prices is still the shoe that's got to drop, or the issue that has to be resolved in the minds of investors. I think we're probably 6 months away from doing that. There are some signs of hope that the housing market's starting to settle. REA Group, they own a mortgage broker called Mortgage Choice. They've said they've actually seen loan applications start to tick back up in the last couple of weeks. So that's not a bad sign. But I think, the jury's out on housing, and that's the part of the equation that local investors are still going to have to sort through. They'll be asking JB Hi-Fi, Commonwealth Bank, Woolworths and Coles, I'll be asking them some really tough questions about how those house prices might be seeping through to operations. But Anthony, does the ASX hitting an all-time high mean we might get a few more companies thinking about listing on the ASX? I mean, we mentioned Glencore at the top of the show. Of course, we keep hearing about a potential float of Firmus, the data centre operator. Does an all-time high on the ASX help confidence on capital markets, or is there still a lot of uncertainty for boards and vendors to deal with?
It helps, right? So it is good. I mean, rising market as a general rule is better than a falling market if you're talking about initial public offerings and market sentiment and getting the conditions right. The problem is, though, valuations can get strong, and then vendors still need to accept an IPO discount, but they'll be looking at the market and saying, gee, the market's really strong. I should be getting a really strong reception for my IPO. I should be pricing at a really big price. So if they want to come to market, they're still going to have to cop a bit of a cheaper price. I mean, that's just how IPOs have always worked, and it's how they always should work.
Yep.
I mean, you still need the good characteristics to make it as an IPO. A good mousetrap, as a banker I know likes to say. So you want, good business, something that makes money, something that's got a good proposition for the customer, a good ability to make money out of it. I mean, you also need a decent management team. It helps if you have a sort of a founder or a seller who's selling for the right reasons, who's aligned with the new investors coming in. Something with a bit of energy and a bit of sex appeal, a hot theme behind it always helps. Although in saying that, boring businesses can also do well if they're easy to understand.
Yeah.
I mean, the other thing that's really helpful is a listed company that's similar, trading really strongly. So last year when we had Virgin IPO, Qantas shares were extremely strong. That was great for Virgin. I mean, it was the same when Myer listed 15 years ago. David Jones shares were trading strongly, and it just really sort of helps get attention on the story. We're at all-time highs on the market front, but I'm not hearing we'll be at all-time highs on the IPO front this year, James. I mean, Firmus could be big. I mean, some people will tell you it could be the biggest IPO ever in Australia, and perhaps it will. But I mean, it's not going to do it alone. They were out there talking to retail brokers this week, lining them up from what I hear.
Yeah.
So they are still working on it. They're trying to get it in front of investors for next month. There's a lot of moving parts there. But outside of Firmus, I mean, there's a couple of other little things kicking along in the background. But yeah, just because the market's at a record high, we're not going to absolutely smash it out of the park on the IPO front.
Speaking of IPOs, we've got another bunch of three-letter acronyms to look at closely next week. CBA and the RBA. We'll be back in a sec to discuss those. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, reporting season really kicks up a gear this week. We've got SGH, or better known as Seven Group, on Tuesday. We've got Commonwealth Bank, the biggest result of reporting season, on Wednesday. And then Telstra and Origin Energy on Thursday. It's really starting to heat up.
It sure is, James. I mean, that Wednesday lineup, CBA, Suncorp, AGL Energy, that's a big day. And I think it really kicks off the big days that'll last for, 2.5 weeks after that?
Yeah. I mean, I think Commonwealth Bank's result will be fine, but everyone is looking at what Matt Comyn, the chief executive, has got to say about the outlook. What's happening with credit growth? What's happening with bad debts? Are there any flow-on effects from the war in Iran? How's the housing market performing? It's going to be a great window into the economy. And it'll also be speaking, Anthony, a day after the RBA makes its August rate decision, or announces its August rate decision. I think you told me on Thursday there's a 3% chance of an RBA rate hike. So we're not expecting any action here, are we?
Yeah, we're back to 0% on the futures market now, James. So even less than 3 now. Yeah, I mean, the market's saying absolutely no chance after that inflation number last week.
But we'll still be interested to hear what Michelle Bullock's got to say about the outlook. I mean, is a rate hike off the table? I think there's still a few economists out there who think there's still a hike in November. You know, the RBA can afford to sit and wait for a little bit longer.
Well, futures markets are flip-flopping as well, James, between one more and no more. I reckon we'll be sitting for a bit.
Yeah, okay, fair enough. And then on Friday, Anthony, one of the great sort of business stories of the year is back in the spotlight as a bunch of KPMG partners and lawyers and advisors head back to front the Senate again. Mm-hmm. This story is not getting much prettier for the KPMG team, is it?
No, it's not, James, and makes some good Friday viewing for people out there just trying to sneak through their Friday. I mean, the last time they had one of these on a Friday, what was it, a month ago or 6 weeks ago? Mate, the numbers watching the stream was massive. I reckon there's a lot of accountants and consultants sitting at home on Friday just trying to sneak through the day that had that on in the background just for a bit of entertainment. So, yeah let's see what happens.
It's the Australian business version of Drive to Survive, so tune in. All right, we love questions here on the podcast. This week our question is from Jake. If you've got a question that you want to send in, you can email us at chanticleer@afr.com. We also love it when you send us an audio question. Just record a voice memo on your phone, include your name and where you're from, and email it to us. Or you can always submit a question via the widget at the bottom of all of our Chanticleer articles at afr.com, which is exactly what Jake's done. We'll ask our producer, Mandy, to do the honours.
It's more of a comment from Jake this week than a question. He says, "Hi, Chooks. It seems as though business leaders on both ends of the political spectrum, think Alan Joyce or Gina Rinehart, cop flack for voicing their opinions. It seems as though neither side of politics are willing to make the case for what needs to be done economically, so it falls in the meantime to our business leaders to do so in public as opposed to private events. But if they are lambasted every time they do so, we shouldn't whinge when they play it safe."
That's an excellent point, Jake, and this is a bugbear of mine. We aren't getting a whole lot of leadership on the economic reform front from politicians, Anthony. Whenever a business leader uses their experience, their insight, their real-world view of the economy to suggest something, often it is politicians who jump on them as self-interested and rent-seeking. I mean, we can't have it both ways here. We want an open dialogue between business and government, don't we? I mean, even the new Victorian Premier, Ben Carroll, said governments are in partnership with business, but it doesn't feel a lot like that.
Yeah, I agree. Everything's getting more polarised. Yeah. It was almost like that productivity roundtable last year sort of gave them an invitation to speak up, and they're a bit more willing to speak up since then.
Yeah.
That said, you know, you go to private briefings by them and they're fantastic. Some of the stuff they say is just really, really punchy. And then you try and get them on the record about stuff and it's really bland. So, I mean, there is a disconnect there. I mean, there are brave ones speaking out, to Jake's point, and we love it when they do because it's just good to have some voices out there. But I agree, the political sort of side of it's just an absolute nightmare.
I sense a different mood in the CEOs that I speak to, Anthony. I think there's been, for the last few years, sort of frustration at the direction the economy's going in, perhaps even a little bit of anger. I'm a bit worried that we're getting to the point of sort of disillusionment where business leaders look to politicians. They can't see a whole lot of interest in reform from the Labor side of politics. The coalition's a bit of a mess, self-absorbed mess. And then you've got One Nation, which is riding in with this sort of populist mix of leftish policies and rightish policies. And so that doesn't provide a great incentive for business to invest, but it also doesn't provide a great incentive for business leaders to come out and talk about what the economy needs to do. So we need to break this cycle somehow. I was encouraged by what Ben Carroll said in Victoria, that we can't have this us against themism that I think, comes into a lot of society these days. And I hope he's right and he's actually serious about breaking that down. I guess we'll see.
Well said.
All right, Anthony, thanks for your help this week and looking forward to next week. RBA, CBA, KPMG, all the big letters. It's going to be good fun.
Have a great weekend, James.
And thanks for listening. We'll speak to you next week. If you like the podcast, share it with a friend. And if you want to read more about what we've talked about today, check out the links in the show notes. And don't forget, you can listen to this and all AFR podcasts on the AFR app. At the Financial Review, we investigate the big stories about markets, business and power. For more, subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson and Anthony Macdonald. It was produced by Mandy Coolin. Our theme is by Alex Gow, and the head of premium content is Fiona Buffini.
The Australian Financial Review.